Have you ever wondered how options traders can profit when they expect the market to make a big move, but they don't know whether the market will go up or down? That's where the straddle strategy comes in. In this video, I'll explain what a straddle is, how it works, when traders use it, and most importantly, what the risks are. Let's keep it simple. A long straddle involves buying one call option and one put option with the same strike price and the same expiry date. For example, imagine Nifty is trading around 25,000. A trader could buy a 25,000 call and a 25,000 put, both with the same expiry. Why buy both? Because the trader is expecting a big movement in Nifty, but doesn't know the direction. If Nifty moves strongly upward, the call option can gain significantly. If Nifty moves strongly downward, the put option can gain significantly. But there is an important catch. You are buying two options, so you are paying two premiums. Let's take a simple example. Suppose the 25,000 call costs 150 points, and the 25,000 put also costs 150 points. The total premium paid is 300 points. So your approximate break-even levels are 25,000 plus 300, which is 25,300. And 25,000 minus 300, which is 24,700. That means the strategy generally needs a sufficiently large move beyond these levels by expiry to become profitable. If Nifty stays around 25,000, both options can lose value because of time decay. And this is one of the biggest risks of a long straddle. The market may move, but if the movement is not big enough, the trader can still lose money. Another important factor is implied volatility. When traders expect a major event, such as a big economic announcement or important market news, option premiums can become expensive. If you buy a straddle when premiums are already very high, the market may need an even bigger move to make the strategy profitable. Now let's talk about the opposite strategy. It is called a short straddle. Here, instead of buying the call and put, the trader sells both. The trader receives premium from both options. The idea is that the market will stay within a relatively narrow range. But there is a major risk. If the market makes a very large move, the losses on a short straddle can become extremely large. So beginners should understand the difference clearly. Long straddle, expecting a big move. Short straddle, expecting the market to stay relatively stable. Long straddle has a limited maximum loss, which is generally the total premium paid, while the potential profit can be substantial if the market makes a sufficiently large move. Short straddle can collect premium, but the risk can be very high. So when should traders consider a long straddle? Typically, when they expect significant volatility but are uncertain about the direction. However, this is not a strategy where you simply buy a call and put and wait. You need to consider the option premium, time remaining, implied volatility, transaction costs, and your maximum acceptable loss.